at your financial ratios. Gross profit margin. This ratio measures how much profit you make on each widget you sell. To calculate it, divide your gross profit by your total revenue. A declining gross profit margin is an early warning sign that something is wrong with your business. Stock turnover ratio. This ratio measures how quickly you sell through your inventory of widgets. The ratio is calculated as follows: cost of sales over average inventory. A declining stock turnover ratio is an early warning sign that you may have excess inventory that's not selling. Debtor days. This ratio measures how long it takes your customers to pay you for the widgets they've purchased. To calculate it, divide your total debtor by total revenue and multiply that by 365 days. A rising debtor days ratio is an early warning sign that your customers are taking longer to pay. Creditor days. This ratio measures how long you take to pay your suppliers for the widgets you purchase from them. To calculate it, divide your total accounts payable by your cost of sales. A rising creditor days ratio is an early warning sign that you're taking longer to pay your suppliers. Interest coverage ratio. This ratio measures how well your business can pay the interest on its debts. Ideally, it should be over 1.5. But if it falls under 1, the business is probably not producing enough cash flow to pay interest. It is calculated as follows: earnings before interest and tax over interest expense. Current ratio. This ratio measures whether your business has enough cash on hand to pay its short-term debts. If it is less than 1, the business might have a cash flow problem. If it is a lot more than 1, the business might have too much cash that could be used elsewhere. Or it is carrying too much stock. It is calculated as follows: current assets over current liabilities. Do you have any questions about financial ratios? Leave a comment below and I'll be more than happy to answer them.